Equinox Gold Corp. (EQX) is navigating a corporate transformation, strategically repositioning itself from a geographically diverse high-growth developer to a financially resilient mid-tier producer with a concentrated operational footprint in North America. This transition is predicated on two fundamental pillars: a major asset divestiture to achieve substantial deleveraging, and the rapid, successful ramp-up of two cornerstone Canadian assets, Greenstone and Valentine. The investment thesis is centered on the subsequent re-rating potential, driven by lower jurisdictional risk, reduced interest burdens, and significant operating leverage to a highly bullish gold price environment. The immediate financial impact of this strategic pivot has already registered strongly with the market. The company reported exceptional third-quarter 2025 earnings, significantly surpassing expectations. This outperformance, coupled with management's demonstrated ability to execute large-scale strategic maneuvers, validates the focus on Canada and the United States. Following the announcement of the Brazilian asset sales, EQX is poised to retire $800 million in corporate debt, an action that will substantially improve the balance sheet and increase per-share cash flow by eliminating high interest expenses. This investment profile represents a high-conviction, leveraged bet on operational execution coinciding with favorable macroeconomic conditions.
The company is backed by a strong buy analyst consensus, reflecting institutional confidence that the successful ramp-up of its Canadian mines will solidify its anticipated 2026 annual production run rate of 700,000 to 800,000 ounces. This report analyzes the structural benefits of the strategic pivot, evaluates the current operational execution, and assesses the critical risks, primarily centered on project execution and the intractable community conflict at the Los Filos mine in Mexico. 2. The strategic pivot, transformation to a Tier 1 North American focus. The most defining event in Equinox Gold's recent history is the decision to divest all of its operating assets in Brazil to the China-based CMOC Group, a transaction valued at more than $1 billion. This move represents a fundamental restructuring of the corporate portfolio, moving away from a diversified global model in favor of concentrated exposure to jurisdictions that offer higher regulatory predictability and operational synergies. The divested assets included the Aurizona mine, the RDM mine, and the Bahia complex, Fazenda and Santa Luz mines. Collectively, these operations were forecasted to produce a meaningful 250,000 to 270,000 ounces of gold during the current year. The strategic calculus here involves intentionally sacrificing approximately 25% of the company's 2025 production volume for substantial cash proceeds and a material reduction in operational and geopolitical complexity.
The management perspective is that jurisdictional quality in gold mining now supersedes geographic spread as the cornerstone of sustainable growth, allowing the company to target a cleaner, lower-risk cash flow stream that should ultimately command a higher valuation multiple. The structure of the $1.015 billion transaction consideration is noteworthy, reflecting sophisticated financial engineering designed to share risk while providing immediate liquidity. CMOC is scheduled to provide an upfront cash payment of $900 million upon closing. An additional contingent cash payment of up to $115 million is tied to production performance thresholds at the acquired mines, specifically relating to production levels between 200,000 and 280,000 ounces. This mechanism ensures that Equinox Gold retains participation in the near-term operational upside of the Brazilian assets should CMOC execute well, without retaining the day-to-day management burden or the inherent geopolitical volatility associated with those assets. According to CEO Darren Hall, this divestment represents a pivotal transformation, positioning the company explicitly as a North American-focused gold producer. The transaction's closing timeline extends into the first quarter of 2026, introducing execution risk related to necessary regulatory approvals across Brazil, Canada, and the United States.
3. Financial architecture, deleveraging, and capital structure efficiency. The principal financial objective of the Brazilian asset sale is the profound optimization of Equinox Gold's capital structure. The proceeds from the sale are explicitly earmarked for a massive debt reduction initiative. Management expects the cash inflow to facilitate the full repayment of both its existing $500 million term loan and a separate $300 million facility with Sprott, totaling $800 million in debt elimination. This large-scale deleveraging fundamentally alters the company's financial risk profile. The retirement of $800 million in high-interest corporate debt will result in a significant annual reduction in interest expenses, providing a direct and immediate boost to free cash flow and improving per-share cash flow. The market often applies a higher valuation multiple to companies with lower leverage, suggesting that the balance sheet cleanup could be a primary driver for stock re-rating, shifting the perception of EQX from a highly geared development company toward that of a more established cash-generating operator. Following this significant repayment, the company's net debt is expected to stand at approximately $1.3 billion. Financial performance in the third quarter of 2025 indicated strong operational execution leading into the ramp-up phase.
Equinox Gold reported third-quarter revenue of $819 million, significantly surpassing the forecasted $703.68 million, equating to a 16.39% surprise. Earnings per share, EPS, reached $0.19, dramatically beating the $0.14 forecast, a surprise of 35.71%. The company generated an adjusted EBITDA of $420 million during the quarter and maintained a healthy cash position, unrestricted cash and equivalents, of $359 million at September 30, 2025. The robust operating margin underpins the financial resilience of the newly focused portfolio. The company's pro forma full-year 2025 guidance places its all-in sustaining costs, AISC, between $1,800 and $1,900 per ounce. Against the backdrop of the current gold market, EQX sold 239,311 ounces of gold in Q3 2025 at an average realized price of $3,397 per ounce. This realized price, when measured against the AISC midpoint, translates to an operating margin of well over $1,500 per ounce. This exceptionally wide margin provides substantial operational security. The improved capital structure and high cash flow generation are critical, as they allow capital to be redeployed into low-risk organic growth projects, such as the Valentine expansion and Castle Mountain Phase 2, reinforcing a self-funding growth model. 4.
Operational momentum. Execution of Canadian cornerstone assets. The successful execution of the ramp-up phase at Equinox Gold's two primary Canadian cornerstone assets, Greenstone and Valentine, is the immediate driver of production growth and valuation. The recent operational data suggests that management is effectively de-risking both projects. Greenstone Gold Mine, Ontario. Operational performance at Greenstone improved meaningfully during the third quarter of 2025. Mining rates demonstrated sequential strength, exceeding 185,000 tons per day, which represents a 10% increase over the second quarter of 2025. This improvement stemmed from enhanced operational efficiencies, including improved cycle times, better equipment maintenance, streamlined shift transitions, and the implementation of hot seating protocols.
In addition to increased throughput, mill grades also improved, rising 13% in Q3 to an average of 1.05 grams per ton GT gold. This trend culminated in September, where mill grades averaged above 1.3 GT gold, supporting confidence in Greenstone's ability to deliver a strong fourth-quarter performance and maintain momentum into 2026. These incremental, measurable improvements in mining and milling are key de-risking indicators, confirming that the company is effectively overcoming the initial operational hurdles typical of large-scale new projects. Valentine Gold Mine, Newfoundland. The Valentine mine commissioning is tracking ahead of schedule. First gold was poured on September 14, 2025, earlier than anticipated. Ore was first introduced into the circuit on August 27, 2025, and subsequent commissioning metrics have been highly encouraging. Throughput between September 14th and September 30th averaged 57% of nameplate capacity. Furthermore, more than 23% of operating days during that initial period exceeded the full nameplate capacity of 6,850 tons per day. The crucial near-term operational milestone for Valentine is the achievement of consistent nameplate capacity, which is anticipated by the second quarter of 2026. The successful confirmation of this milestone is the single most important operational catalyst for the stock, as it will cement the company's expected high-volume run rate.
2026 production outlook and organic growth. The positive ramp-up trajectories at Greenstone and Valentine position Equinox Gold for substantial production growth. Assuming the successful achievement of nameplate capacity at both sites, the company anticipates an annual 2026 production run rate of between 700,000 and 800,000 ounces of gold. This consolidated, high-margin production base in Tier 1 jurisdictions represents the core value proposition of the transformed entity. Beyond these immediate ramp-ups, the company is defining future organic growth through pipeline projects in North America, including the Valentine expansion and Phase 2 at Castle Mountain.
This combination of immediate cash flow from the newly simplified portfolio and a lower risk expansion pipeline provides a clear runway for production and cash flow growth extending beyond 2026. 5. Critical risk assessment and mitigation strategies. While the strategic pivot and operational execution metrics are largely positive, significant investment risks persist, particularly related to social license to operate in Mexico. The Los Filos community conflict. The most acute operational risk facing Equinox Gold is the ongoing severe community conflict at its Los Filos mine in Mexico, which currently remains under an indefinite suspension. The dispute has persisted for 7 months and centers on fundamental disagreements regarding the terms of land use and social compensation.
Community grievances are extensive, demanding preferential access to employment, attention to documented serious health harms, many cited as irreversible, and access to clean water free of heavy metals, a core commitment that communities assert has been unfulfilled by various operators since 2007. The situation has escalated beyond local grievance to regulatory intervention, highlighting a systemic failure in social license management in the region. The Mexican Environmental Protection Agency, PROFEPA, shut down the company's New Filos project for failing to comply with remediation measures that had been previously requested. The company is also accused of violating environmental law by failing to perform basic maintenance and adhering to the management plan authorized by Semarnat. The severity of the conflict and the allegations of environmental neglect create a profound contradiction with Equinox's stated commitment to responsible mining and its comprehensive ESG reporting framework, which includes adherence to responsible gold mining principles. The community has accused the company of attempting to provoke incidents and criminalize their struggle, emphasizing the fraught relationship.
Impact on investment thesis. The persistent crisis at Los Filos creates a material ESG overhang and subjects the company to a market discount for uncertainty multiplier. However, the financial impact on the core North American growth thesis is minimized. Post-Brazil divestiture, the company is essentially treating Los Filos as a non-productive asset until the complex socio-political and regulatory issues can be comprehensively resolved. Therefore, the critical risk is reputational and related to the long-term potential for institutional investors who prioritize strong ESG credentials to limit their adoption of the stock until the Mexican assets are either sold or successfully remediated. Paradoxically, the acute difficulties at Los Filos retroactively validate management's strategic decision to divest its Brazilian operations and concentrate capital and resources entirely on the more stable, predictable North American operating environment. The company is demonstrating a pragmatic strategy of risk avoidance by optimizing its portfolio for jurisdictions where it can execute growth plans with greater regulatory and social certainty. 6. Valuation context and macroeconomic tailwinds. The investment case for Equinox Gold is highly sensitive to the current bullish macroeconomic environment for gold, positioning the company to maximize returns from its newly focused North American asset base. The gold price trajectory. The precious metals sector has experienced extraordinary strength, with gold prices soaring in 2025. The metal reached approximately $4,300 per ounce toward the end of 2025, marking the strongest annual performance since 1979. This momentum is driven by persistent factors, including strong central bank and investor demand, geopolitical tensions, and an environment of low real yields caused by persistent inflation concerns and anticipated interest rate cuts. The outlook for gold prices remains significantly bullish. Market projections indicate that prices are expected to push toward $5,000 per ounce by the fourth quarter of 2026, with longer-term possibilities approaching $6,000 per ounce.
Financial gearing and margin expansion. Equinox Gold is exceptionally geared to this anticipated gold price appreciation. The key financial multiplier is the substantial operating margin derived from the difference between the low AISC guidance, $1,800 to $1,900 per ounce, and the high realized gold price. If gold prices sustain the current level of approximately $4,300 per ounce or approach the forecasted $5,000 per ounce level, EQX will generate a cash flow margin per ounce exceeding $2,400 to $3,000 respectively. This massive leverage, combined with the expected 700,000 to 800,000 ounce production run rate in 2026, will generate free cash flow significantly in excess of current market consensus. Such an outcome would accelerate the paydown of the remaining $1.3 billion net debt and potentially enable capital returns to shareholders much sooner than analysts currently anticipate. Analyst consensus and price targets. The institutional view of Equinox Gold is highly favorable, supporting the growth-oriented investment narrative. The company currently holds an average brokerage recommendation, ABR, of 1.40, calculated based on 10 brokerage firms, with 7 rating the stock as strong buy and 2 as buy. This broad consensus reflects confidence in the management team, led by Darren Hall and supported by the industry pedigree of Chairman Ross Beatty and successful resource entrepreneurs like Mr. Johnson, who collectively have a history of generating substantial shareholder value. Based on short-term price targets provided by 9 analysts, the average price target for Equinox Gold is $16.59, implying a potential upside of 12.86% from the current closing price of $14.70. The range of forecasts spans from a conservative low of $13.68 to an aggressive high of $20.16. This significant spread is a function of varying assumptions regarding 2 key variables: the timeline for successful operational execution and the assumed gold price environment. The high-end target of $20.16 likely models the timely achievement of Q2 2026 Valentine capacity milestone, combined with a conservative view of the $5,000 per ounce gold price forecast, reflecting the massive financial leverage inherent in the business model under a strong macro scenario. 7. Conclusion and sensitivity analysis. Equinox Gold Corp has completed a definitive strategic transformation, pivoting the investment thesis entirely onto high-quality, growth-oriented assets located in stable Tier 1 jurisdictions, while simultaneously executing a significant deleveraging effort. The company has essentially traded non-core volume and geopolitical complexity for financial stability and enhanced production certainty.
The investment risk has now primarily converged onto project execution. Investors must monitor the Valentine gold mine achieving consistent nameplate capacity by the second quarter of 2026 as the definitive metric for success. Should this milestone be met, the company will solidify its 700,000 to 800,000 ounce production base, resulting in substantial cash flow generation at current gold prices. The company represents a highly leveraged vehicle for participating in the ongoing bullish gold cycle. A sensitivity analysis confirms that given the narrow margin between the pro forma AISC, $1,800 to $1,900 per ounce, and highly ambitious gold price forecasts, $5,000 per ounce by Q4 2026, every $100 increase in the realized gold price will disproportionately amplify free cash flow. This financial sensitivity provides the runway for the stock price to test and potentially surpass the high-end analyst target of $20.16. Conversely, the primary downside risk remains operational delays at the Canadian assets or a sustained deep correction in gold prices. The long-standing unresolved crisis at Los Filos remains a structural ESG risk, but its immediate financial impact on the company's near-term North American cash flow outlook has been structurally mitigated by the focus shift. The overall investment profile is defined by a significantly reduced debt profile, demonstrated operational momentum, and maximal exposure to anticipated high-grade gold margins in a favorable macroeconomic environment.